Well, markets have jumped strongly as it looks like the US presidential race is all but decided. Hi there everyone, welcome to the Traders Circle weekly market update. Today is Wednesday, the 6th of November, 2024, and before I get started, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for you. So we'll start with the US presidential election, and the results have come throughout our session today, and it looks almost certain that Donald Trump will become the next US president, defeating Kamala Harris. Unfortunately, the final counts won't be known for a while yet, and it's not guaranteed yet, but it does look like the likely outcome from here. Markets seemingly have applauded this decision. We've seen our market push strongly higher today. We've seen US futures jump strongly higher. The Japanese market jump strongly higher. And in general, there's a sense that this is an outcome that the markets are happy with. I will, however, caveat that by saying that we've seen the Chinese markets push lower today. And that could be because last time Trump was president, he enacted a bunch of tariffs and trade protectionism that did damage the Chinese economy. He's announced that he's probably going to do something similar this time around as well, so no surprise that those markets have gone down as well. That is not a great thing for the Australian market. We have a lot of large iron ore miners, a lot of large companies in general that sell materials to China, and if the Chinese economy is hurt by American protectionism, that could eventually hurt our own companies. I'm thinking of BHP, Rio, Fortescue, but even some of the smaller companies as well. Regardless, though, I do think in the short term we could see a night of optimism in the US, but I don't think it's necessarily that positive for the market overall. And the reason I say that is because the policies that Trump's announced he will do, which includes the tariffs and the trade protectionism, but also includes things like large corporate tax cuts, they're actually quite inflationary. So when you do a large tax cut, it essentially increases the amount of net government spending, which is money pumping back into the economy. And similarly, when you do things like tariffs, you're increasing the price of imported goods, which also pushes prices higher. Now, US inflation has been remaining stronger than expected for the last few months now, and that goes with other strong US economic data as well. We've seen the Fed start to cut interest rates, and I do think there's a real risk that we see, inflation push back up from here, or at least remain stickier than expected. And I do think that could be a sign that we're not going to see the rapid series of rate cuts everyone's expected. So we saw US bond yields bottom out as the Fed cut interest rates in September, and since then those bond yields have actually been pushing up strongly higher. It's a similar story here in Australia, and our own bond yields have skyrocketed, and our own inflation data has been a bit stickier than expected as well. It's going to be a bit difficult for shares to have too much further upside if inflation keeps coming in hot, because that's going to mean that interest rates are going to remain higher for longer. We're going to see bond yields keep rising. Already, equity risk premium or share prices relative to bond yields are pretty expensive. So I think that sort of potential for further inflation with the Trump presidency could limit further upside for shares. And that does bring us to the central banks. Yesterday we saw the RBA deliver their November meeting. They kept interest rates unchanged, kept them on hold, but very importantly they were hawkish in their statements. They basically said that underlying inflation is remaining stickier than expected. They said that headline inflation came down with short-term factors like the energy rebates from the government, and that underlying inflation was taking a lot longer to shift than expected, and they pushed out their expectation for inflation returning to target until 2026, which is not a good sign for anyone borrowing in Australian dollars. It basically means that the RBA doesn't see a rate cut anytime soon. That's not a good thing for the Australian stock market. Our market didn't really move on the news, and we've been so focused on the US, we've been so focused on what they're doing that we followed them higher today as well, and we'll probably follow them higher in the coming days, but it does limit our upside. I've said it for a few weeks now, as long as our bond yields are rallying or rising as hard as they are, I'm not sure we're going to look as bullish as we did earlier in the year. And it's a similar story in the US. They will see a Federal Reserve meeting tomorrow night. and the Fed is actually expected to cut interest rates a little bit further. However, their dot plot in the accompanying statements, that's expected to show that members are expecting less rate cuts moving forwards. And indeed, because the market started to expect that, we've seen US government bond yields start to push up as well. I suspect that, at least in the short term, a Trump presidency will only increase that rise in bond yields and decrease bets on further rate cuts. And that will, I believe, limit further upside for shares. It looks like we're seeing a pop today. We could see a little bit more further upside. And, obviously markets will love any announcements around tax cuts, corporate tax cuts, things like that. But I do think that with that potentially increasing inflation and increasing bond yields, it means that markets aren't going to be as longer term bullish as they have been. So let's have a quick look at the charts for this week, guys. We'll have a quick look at the Australian market, the XJO, and we can see that it's really been coming off since its all-time high in the middle of October. We've actually set potentially a lower peak and a lower trough now, and we're now looking to see if we get that third lower peak and then potentially a third lower trough. We've got some pretty key levels of support and resistance. So support I see right around 8100 and resistance at 8270 roughly, and we're also holding right around the 50-day moving average. Overall, I think there's plenty of likelihood that we just track sideways from here. We've got what I think the market sees as positive short-term fundamental news, and that's in the form of the US presidential election. This is a cyclically bullish period after the election. Like I said, markets think they might get some tax cuts in the US, and that's potentially fundamental positives. But we've also got some negatives in the form of the rising bond yields, stickier than expected inflation, and potential weakness to the Chinese economy if there is US tariffs and US trade protectionism. Overall, that could mean that we're moving sideways, but there is a bit of a caveat there, and that is the bank reporting. Bank reporting was somewhat disappointing from Macquarie and Westpac. We're going to see some reports from ANZ, NAB, CBA in the coming weeks, and if those reports are disappointing, and I think they probably will be, at least relative to the share prices, it might be a bit hard for our market to see further upside as well. So let's have a look at the US charts for this week. And this is the US S&P 500. They did break their short-term uptrend line with some bearish movement over the past week, but they fell back to a previous support level. That was their support level at the start of October. There's also the 50-day moving average, and they held it as support at roughly 5,700. Overnight, they closed around resistance, right around 5,770, 5,780. But with the futures movement today and that post-election bliss, I think they will probably push back towards the all-time high, right around 5,870. I did say that I'm not convinced markets will be quite as bullish as they have been, and I'm not sure we'll see too much further upside from there. I would not be surprised at all to see sideways movement around here, because I do think we're going to see a return to concern around inflation, a return to concern around higher bond yields, and shares looking relatively expensive compared to alternative asset classes like bonds. So yeah, I will wrap it up there for this week, guys. Hopefully you enjoyed. If you did, click like, click subscribe, and we'll see you next time.